Welcome back to the channel, folks. Today, we're diving headfirst into the world of real estate. Brace yourselves for some eye-opening insights into the housing market. But first, I've got to clear something up. No, there hasn't been a housing market crash. Let's put that rumor to rest. I've got the numbers to prove it. All right, let's kick things off by taking a closer look at home prices. We'll examine the data from the last 5 years to see what's really happening in the market. Hold on to your seats because the median sale price of a home in November was $8,732. That's a 3.7% increase over the past year. So let's not jump to conclusions about a housing market crash just yet. Now let's zoom in a bit with a one-year chart to see the month-to-month action. Surprise, surprise. Home prices fell by $591 or 1.4% from the prior month. But guess what? This dip was expected due to seasonality. The big institutions may not have seen it coming, but common sense prevailed. So let's not hit the panic button just yet. Enough about prices. Let's shift our focus to housing inventory. Currently, there are 1.49 million homes listed for sale in the U.S. Year over year, the number of homes for sale is down by 7.8%. And month over month, it's down by 4%. What does this mean? Well, we've got fewer sellers in the market right now. Before we go any further, it's essential to consider the demand side of the equation. Are there enough buyers out there to keep the housing market afloat? That's the question we'll answer next. But wait, there's more. In this segment, we're diving into the world of mortgage rates and how they impact the housing market. Mortgage rates are a game changer when it comes to home buying. So stick around for some crucial insights. Now that we've dissected the housing market from various angles, it's time to connect the dots. How does the real estate market influence the broader economy, and what does it mean for you? Stay tuned for our final thoughts, where we'll summarize key takeaways and offer insights for both prospective homebuyers and investors. And remember, if you're enjoying this content, don't forget to show your support by liking this video and hitting that subscribe button. Your support keeps us going. Now let's tackle another critical factor that's driving the real estate market: mortgage interest rates. Brace yourselves, because this one's a game changer. Here's a one-year chart showing the average interest rate on a 30-year fixed mortgage. In October, it peaked at a whopping 8%, but then it plummeted to 7% in no time. And now it's dipped below 7%. Here's the catch. Falling interest rates stimulate demand. When rates drop, homes become more affordable, opening doors for more people to buy homes. More demand, more buyers. You get the picture. Now, here's where it gets interesting. The Federal Reserve has signaled that they won't be raising interest rates in this economic cycle. In their summary of economic projections, they're even talking about cutting interest rates 3 times next year. So naturally, that means lower interest rates on mortgages too. The expectation is that mortgage rates will fall to 5% to 6% in 2024. But here's the real kicker. The Federal Reserve is expected to cut rates even further after 2024 and 2025. So we're looking at an extended period of lower interest rates. So there you have it, folks. We've delved deep into the world of mortgage interest rates and their influence on the housing market. Now, it's time to connect all the dots and see how these pieces fit together. What does this mean for aspiring homeowners, seasoned investors, and the broader economy? Now, let's delve into a question that's been on many minds. Could we ever see mortgage interest rates as low as 3% again? My honest response is that I wouldn't be surprised. The big financial institutions and major players in the market love easy money. Will it be inflationary? Absolutely. But for most people, they tend to focus on the short term and might not be overly concerned about the long-term consequences. However, I wouldn't advise getting your hopes up for 3% mortgages in 2024. Perhaps in 2025, but for 2024, expect interest rates in the range of 5% to 6%. This will indeed add some inflationary pressure to the mix. Now, moving on, let's take a look at the number of homes being sold. Check out this. The transaction volume is at significantly lower levels compared to prior years, and the number of home sales is depressed when compared to previous years. Let's shift our attention to another interesting metric. What percentage of homes are selling above their list price? Currently, it's at 28.7%, which is getting back into the normal range but on the higher side of normal. This figure is slowly trending down but remains 2.3% higher than it was 12 months ago. Now let's turn our focus to migration patterns. There's still significant outflow from California, and New York is also seeing a fair share of residents moving away. My home state of Illinois is in the mix too. On the flip side, Florida remains the #1 destination, but migration to Texas is showing signs of slowing down. So, what can we expect from the housing market as we transition from the current year into 2024? If you're in the market to buy a home right now, it's a challenging situation. Home affordability is at record lows due to the combination of higher interest rates and home prices soaring by 40% compared to pre-pandemic levels, according to Zillow. It's so skewed that the average household income can't cover the cost of the average home. Fannie Mae reports that a whopping 86% of Americans who had plans to buy homes in 2023 had to put those plans on hold, a record high. Currently, home prices are on an upward trajectory year over year. The National Association of Realtors reports that 80% of U.S. metros have experienced price increases year over year. This paints a challenging picture for home buyers as we navigate the complexities of the housing market. Now, I understand what some of you might be thinking. You might argue that since home affordability is at record lows, the only way to go is up. I agree that the situation will eventually improve, but it won't happen overnight. It'll be a gradual process, not a sudden shift. With significantly low inventory levels, 2024 will likely remain a seller's market. While it may not be as robust as it was 2 years ago, without a substantial increase in supply, it won't suddenly transform into a buyer's market. Affording a home in 2024 will still be out of reach for millions of Americans, and that's the honest truth. I understand that this may not be the news people want to hear, but it's the reality we're facing in 2024. Perhaps things will significantly improve in the fourth quarter of next year or in 2025, but that's still a bit down the road. Some people argue that a housing market crash will occur because the economy will crash. While it's a straightforward argument and not impossible, it's essential to note that the expectation is for the economy to deteriorate somewhat. That's the baseline scenario. However, an economic depression or another Great Recession is not very likely. Why? Because if things start falling apart more rapidly than anticipated, the Federal Reserve has a trick up its sleeve. They can cut interest rates. In such a scenario, they would likely do so even more aggressively, flooding the economy with easy money. So here's my assessment. In 2024, the Federal Reserve will cut interest rates, causing mortgage interest rates to go down slightly. This will modestly improve home affordability, but it will also increase demand. So, if you're expecting an exciting 2024 in the housing market, I apologize for the rather boring truth. No real estate crash and no dramatic price surges. Of course, specific cities may have their unique circumstances, and there will always be outliers. So, if you're in one of those cities, you might indeed have an exciting 2024. However, for most Americans, I would advise against counting on it. That's all for today. Please consider subscribing. I appreciate your support, and I wish you a fantastic day.